This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode number 21 was recorded on June 24th, 2019. I'm Eric Townsend. All-star Julian Brigden from MI2 Partners joins us this week. Julian, last we spoke, the resurrection of the Trump-Xi China-U.S. trade deal had not quite materialized yet. Now that it has, it seems like the dominoes are being lined up for a China-U.S. trade deal to maybe set the context for a market rally that perhaps President Trump hopes will take us right through the election. Can he pull it off? Is there a way for President Trump to line things up so that it works, or are we headed for trouble in this market no matter what people do?
Well, here's what I would say. I think depending on where you sit, there's a lot of assumptions still baked into the market. So I think over here, you know, the art of the deal group would have assumed that, you know, Trump was just playing hardball and then it was up to him to be able to back off and deliver the deal, right? He was the one who held all the cards. It was, you know, he was going to play it really, really hard as he could, get some concessions from the Chinese, and then just be able to claim victory. And I think that was just a very naive perspective because, of course, you know, it takes two to tango. And just as the Americans, in a way, were visually and, you know, physically with Huawei tightening their stance, so the Chinese were tightening their stance. And I think it really is we've got to see the Chinese compromise a little bit. And I'm not sure that they're quite as willing. So, look, I think everyone wants to continue talking. I don't think from a timing perspective, it serves anyone to have a real severe deterioration. I mean, the Chinese, if you look at a lot of the data, it suggests that they're having sort of funding problems, certainly in the private sector on the dollar side. It's just not a good time for them to be picking a real fight. Obviously, we know Trump wants a strong stock market. He wants a electoral victory in 2020, right? We've just seen him start his campaign trails. So I think what we're looking at, Eric, is probably something more akin to détente. You know, and for those people who aren't old enough, that's the sort of state of affairs that existed between Russia or the USSR, as it was called in those days, in the US, where we sort of agreed to stay out of each other's way directly. And I don't think that does anything for this long-term breakdown in certainly telecoms and technology that we're seeing, and this sort of development of two systems, you know, this inability of US tech companies to sell into China. I think that is going to continue. That's national security. That's very, very hard to address. I mean, I think it's going to be very hard for Trump to make the sort of concessions that the Chinese would want to see in terms of Huawei to truly do a major deal. But will they smile, shake hands, say, you know, we're going to carry on talking? Yeah, I think they will. I think it's in everyone's interest. You know, and in this market, that's probably enough. I don't think we get another increase in the tariffs. I'd be surprised. I mean, that would be, from what I'm hearing, even if they do increase, you're looking at 10%, not the full 25%. But that would be a bloody bad sign. I mean, if that doesn't happen, that means that there's something really rotten at the core. And while I think there is, I think everyone's got interest in sort of punting this.
Let's stay on this geopolitical track, Julian, because the Middle East tensions have been ratcheting up. Let's talk about what that means for markets. You know, at first, it seemed like this Iran situation, at first everybody wanted to blame Iran, but then people said for those tanker attacks, maybe Iran didn't do it, maybe they were being set up. It almost felt like as soon as a lot of analysts started to say, maybe Iran didn't do it, the very next day, Iran did something else and took credit for it. Just make sure everybody knows we're doing this stuff. You know, we're doing it. It really surprised me that that happens. So what is Iran trying to accomplish? What's it going to mean for markets, and where is all this headed?
So look, I think I don't think it's in anyone's interest, so either side's interested to just particularly scale this tension back. I think the Iranians are suffering quite dramatically. I mean, there was an interesting quote, I think it may have been in the FT, where they'd interviewed some guy in Iran and a merchant, and he said, well, isn't this war already? I mean, these sanctions are horrific, and we're recording this on Monday morning, and it looks like we're getting another wave of sanctions. It seems almost more impossible that we could tighten them anymore. But I think the Iranians view themselves as essentially being at war already, but it's just not a kinetic, directly, should we say, high-level kinetic war. It's just a little sort of guerrilla war at this point. I think the Iranians are just showing quite successfully that they have the ability to shut the Gulf Channel if they need to. And I think that pressure is going to be slowly ratcheted, not to the point of really provoking the US. And I don't think Trump really wants that either, right? I mean, this is a guy who is very wary about going the sort of Obama route or the Bush route and getting us involved in fighting wars. I mean, he's an isolationist, essentially. He's America first. And I don't think it serves, as we've seen over many years now, that it serves American purposes to definitely get involved. But neither do I see how either side backs down, right? So if we do some more tariffs, do the Iranians do something else just to, keep the tensions there? I think the answer is yes, they do. I'm a little surprised, I'll be honest with you, Eric, I'm a little surprised how little oil is reacting, right? I mean, I think I would have expected it to be, above $60, and it isn't. It's trading very poorly, in fact, especially given since we're seeing some nascent signs of weakness come in to the system. So, but I don't think this is going away. I don't think either side wants it to really escalate out of hand. There's some talk that there was on the day that they shot down the drone, they also targeted a US aircraft which had a very large crew. It looks like it was going to be a SEAL team or something that they were going to, or a Delta team that they were trying to infiltrate, because it had 36 versus I think the normal crew of 8 on this thing. And they made it very clear to the Iranians when they got targeted that they had people on board and it wasn't a drone. And then the Iranians backed off. So I don't think they're really in a situation where they want to see this get really out of hand. But do they just keep this low-level guerrilla warfare going on just to make sure that the Americans know they're there? Look, at any point, they could escalate things quite dramatically if they wanted to. I mean, those drones have been very effective at pushing up tanker insurance rates. That's going to cause a squeeze at some point because there's a lot of tankers just sitting outside who seem at this point unwilling to pay the insurance rate. What does the US do? Does it send Aegis destroyers into to escort these guys? And if it does, can they really be that effective if the Iranians decide to swarm 1,000 drones on them? I mean, they're cheap relatively compared to, an Aegis destroyer. Sure, it could take down, 100, 200 of these things. That's what they're designed to do. They're amazing ships, but they're not going to be able to totally combat this thing. So you could get these things to really accelerate. But as I said, I'm actually frankly surprised that oil is not more bid. And I quite like it if it dips again. I think I'd be a buyer, given that I think we're showing signs, as we said, of in the background, this nascent dollar weakness.
Let's talk a little about the stock market, because you have predicted that eventually this rout in bond yields is going to end. So far it hasn't, and it seems to me that as long as we have these very low interest rates, it sets the stage for even more corporate buybacks, and maybe this equity rally can sustain itself a bit longer. What's the update both on your stock market outlook and particularly how it integrates with your bond market outlook? Because I would think that there's a close relationship between the two.
Sure, absolutely. Look, we've been looking for a reflation trade since the start of the year, frankly. Since that Powell mea culpa where he stood next to Ben Bernanke and Janet Yellen like some sort of petulant schoolboy and read from a sheet, I will not be a naughty boy, I will not do this again, in terms of tightening rates. We've been looking for the reflation trades. And, the equity market's been one place that you've seen it, but what's been very interesting is that you haven't seen it in a number of other sort of markets, most notably the bond market. But if you cast your mind back, our sort of playbook has really been sort of 2016. And when Janet pivoted in early 2016 after China had devalued and we were heading into some sort of emerging market sort of crisis. So I think that last week's FOMC was potentially transformative. We've been long bonds, for MI clients via TLT and MI2 clients via 30 years. We recommended getting out of both of those longs last week or the week before. Hasn't really gone anywhere at this point, and I'm fine just sitting here flat, for want of a better term. The equity market, the equity market's responded as you would expect the equity market to do in a reflationary sort of environment. We've rebounded back up to the highs. I think a lot depends on, whether the Fed can and will deliver. I'm a little concerned, and one of the reasons we recommended taking profits in the long fixed income trades is I'm a little concerned that there's a disconnect going on between market expectations and what the Fed can and will deliver. The expectations are becoming really, really extended, and it's really in the mind of the market themselves. Now, I do think that the Fed has to respond to that, and they should, over the next couple of weeks, guide whether they're going to go 50 or 25 in July. But I'm a little concerned, and that's why I'd cut the longs in the fixed income market. But I think they're going to try and punt this cycle. Eric, I've been very adamant that I'm a seller of fixed income on rallies, not a buyer. So the long that we've had since the end of last year in treasuries was a tactical trade. It's a good tactical trade, but nonetheless, it was a tactical trade because, if they punt this cycle, if they keep this game going, albeit, through the election to 2021, I think that there is an inordinate risk and potentially an inordinate cost for punting a cycle where you have 3.5% unemployment, 3% wage growth, and 2% CPI, which are radically different from the levels you started in 2016 when Janet punted it.
Julian, let's talk about the U.S. dollar. The dollar bears a few weeks ago told us the dollar was going to crash, and I kind of thought, oh boy, here we go again, more rhetoric. Well, so far, the tape's agreeing with them. I think it's going to be temporary, and there's still more upside to the dollar. But if you're a dollar bull and you're long the dollar index, as I am, this tape's getting a little bit scary. What do you think here?
Well, it goes back to the previous thing. I mean, look, if they're going to punt the cycle, okay, they ideally need two things, the Fed. Firstly, they have to engineer a higher equity market. Okay, well, so far so good. But a lot of that's very much dependent on the bond market. And as I said, I'm struggling to see. I think there's a risk actually of a bond market sell-off at some point. After all, we got that in the summer of 2016 after the reflation trade took hold. But they also needed a weaker dollar. I think we've been shown how to generate a weaker dollar. As soon as we've priced in sort of 4 cuts into fixed income, into the US curve, then in actual fact, you've started to see signs of weakness. Now, I know no other central bank will want that, but frankly, the Fed holds the best cards. Not all the cards, right? But what the hell is the ECB going to do? I mean, the Fed's got, if you look at short rates, the Fed's got 300 basis points over the ECB. So they can bitch and moan, but guess what? Well, they're going to push them another 50 basis points negative. All right, fine, screw your banking system even further. But the Fed can cut them 200 basis points, 150 basis points. So there's nothing that the ECB in the end can do, bar launch another wave of QE, which I don't believe is as easy as they think, to prevent the euro strengthening. So to me, we haven't got a dollar trade on at the moment, Eric. We've been a little reticent to put it on because I do want to make sure that we get through these trade discussions soon. But there are signs, I think, the dollar, and we talked about this when we did the piece with Juliet, the three of us, when we talked about 2016, that if you look at the big picture, we're on the cusp potentially of a big down move in the dollar. If you look at it cyclically, it's time. I don't think the conditions are quite right, but I haven't had a dollar. We've had some dollar bull views in some of the Asian stuff, But against the euro and things like this, we just having been super bullish into the end of last year, we haven't had a position, versus the euro or the DXY for 6 months, because I just don't think it's going anywhere. If the Fed is serious, though, and they want to keep this game going, and they cut enough, then I think it's the downside in the dollar that you've got to be focused on, not the other way.
Julian, thanks so much for another fantastic All-Stars interview. We look forward to getting an update from you in a couple of weeks. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.